Hello, we're here to talk about the anatomy of different accounts, and we're going to talk about prepaid assets. Now you'll remember by definition an asset is increased by a debit and decreased by a credit. And prepaids would include things like prepaid rent, prepaid, in this case we have prepaid rent, but we could have prepaid insurance. That would be another one. And so we would expect to see a beginning balance that's an asset, and we would expect to see an ending balance that's a debit balance as well. And we know that prepaids are increased when we buy insurance or rent before they're due or before they're used. And their prepaids are credited when they're used or consumed. So here's some facts. It says that the beginning balance is $12,000 and that the ending balance is $15,000 and that rent expense from the income statement was $21,000. Well, if it's used or consumed, that's what you would expect to see on the income statement is rent expense. So rent expense, $21,000. So the question here is how much cash did you pay to buy rent ahead of time this year? So we can see that, well, math wizards that we are, what we do is we start with the end, reverse the signs, and that will give us the answer. So 15,000 plus 21,000 minus 12,000 says that during the period we bought rent for $24,000. And to prove that to myself, I can take the beginning balance of 12 plus what I bought, 24, and subtract what I used, 21, and guess what? I get the ending balance. So this is a brief overview of prepaid assets, specifically prepaid rent. But it works for insurance too. Thank you so much.